Hello everyone and welcome to Crypto Red, the channel for crypto news. We've got some good news for Ripple and I'll get to that in just a moment. We're also going to talk about Donald Trump, who has just signed 2 executive orders that are extremely positive for cryptocurrencies. We'll also cover Chainlink as well. They're building a reserve for Link tokens, but honestly, there's one thing about it that worries me and I'll share my thoughts on it. And we'll also talk about stablecoin ratings and Pump.fun. In short, a lot to cover today. Let's start with cryptocurrency prices. As you can see, it's pretty green today. Good news for a lot of crypto. XRP up 8% and a lot of cryptocurrencies up. And let's talk about Ripple. Really good news here. The lawsuits with the SEC is officially over. This case has been full of twists and turns. The SEC against Ripple. At first, the SEC wanted to appeal, then Ripple wanted to appeal. Now it's over. No more SEC against Ripple. The previous court decision still stands. That means XRP is considered the security when Ripple sells it to institutional investors, but XRP sales on exchanges are not considered securities. That's a clear positive for the XRP token. This has been seen as a partial victory at the time, but now with the change in administration in the US and the new leadership at the SEC, there's no longer any real issue regarding XRP sales on exchanges. So the case is closed. So XRP fan, hopefully this means the token can keep climbing. Another recent move from Ripple, they've been focusing more on stablecoins, especially their stablecoin, the RLUSD. This stablecoin already has around $600 million in market cap, and now they've made a major acquisition in the stablecoin space. They bought a company called Rail for $200 million to boost the use of RLUSD. This company, Rail, is basically a platform for stablecoins that integrate banking-like features, account for holding and managing stablecoins, payment infrastructure, and more. A lot of companies are getting into stablecoins because they see the use case expanding everywhere. Businesses will need tools and solutions to accept and make payments in stablecoins, and Rail is aiming for that market. Ripple clearly doesn't want to miss the opportunity. If they can build a product that's widely used by companies and push RLUSD adoption, that's a big win, both for the stablecoin and for Ripple, which earn revenue from RLUSD reserves invested in things like US Treasuries. For me, Ripple's original use case and the way they positioned themselves early on was all about value transfer, moving value between institutions, at a time when Bitcoin was mainly seen as a store of value. They were ahead of the curve in some ways, but I feel like they let themselves get overtaken by the rise of stablecoins. Launching RLUSD now is them trying to catch up. Ripple fans will say it's complementary to XRP, and I understand that view, but in my opinion, Ripple should have launched RLUSD years ago. They should have launched their EVM-compatible blockchain years ago as well, because they've been around for over a decade, and yet they let other projects get ahead. The big question now is how much will RLUSD growth benefit the XRP token directly? The ideal scenario is that Ripple grows both ecosystems in parallel, RLUSD and XRP, creating a synergy where the more RLUSD used, the more XRP used too. If that happens, it makes sense. And it's good for both tokens. But if RLUSD just grows and only brings revenue to Ripple, the company, without driving XRP usage, then XRP holders might not see much benefit. That said, Ripple has billions of dollars in reserves. They can make plenty more acquisition to develop both XRP and RLUSD. Finally, excellent crypto news from the United States. Trump has just signed 2 executive orders. They had been announced before, but now they're officially signed. The first one prohibits banks from shutting down accounts or refusing to open accounts for startups or individuals related to crypto. Simply because they're involved in crypto. This is extremely important. Many companies have run into trouble because of this, including founders of crypto companies and so on. But the other point, and I think it's even more bullish for crypto, is the decision to allow cryptocurrencies in American retirement accounts. You know, I'm talking about 401k plans, which are accounts where Americans invest regularly for their retirement. In most cases, the employer also matches the employee contributions, so it's a powerful way to build a sizable retirement fund through capital accumulation. Until now, there's been strong opposition to putting crypto into this account, but Trump is changing that. He's saying, no, crypto and alternative assets should be considered on the same level as stocks. And that's a good thing, because it could unlock billions and billions of dollars flowing into the crypto market. For BTC and ETH, this is already possible through ETFs in these accounts, but for other altcoins, it's not the case yet. So to me, this is especially good news for altcoins because it means a whole new wave of investors, people who may have hundreds of thousands of dollars in their retirement funds, will now be able to easily gain exposure to these assets. Definitely a big win for crypto. Next, let's talk about Binance. They've signed a partnership with the Spanish bank BBVA. La Liga fan will recognize the name. This agreement allows BBVA to handle custody for certain Binance clients, especially institutions and high-value traders with millions of dollars. These clients will be able to keep their funds in custody at BBVA while still trading with margin and so on. Here's how it works. The collateral stay at BBVA and the balances with Binance are simply settled every few hours, every 4 hours or every 8 hours, for example. That means even if Binance were to shut down overnight, the vast majority of the funds would remain safe in the Spanish bank, avoiding an FTX-style collapse for those clients. It's actually a model similar to what Ethena does. I've talked about Ethena before, a platform for generating yield on stablecoins. Historically, they've offered around 15% annualized return. They operate across multiple exchanges, Binance included, but the funds themselves are stored with trusted custodians. Only a very small percentage of Ethena's portfolio is ever on a centralized exchange at a given time. That's why when there was an issue with the Bybit a few months ago, the impact on Ethena was tiny, maybe 1% or just a few $1 million were at risk. This kind of setup is a good thing. People are learning from the FTX collapse and avoiding the same mistakes, and that's a big step forward. As I said before, I think Ethena is a great option if you want to generate yield on your crypto, whether that's stablecoins or even BTC and ETH. There are ways to borrow stablecoins against this crypto to put them to work and generate truly passive income. Now, on to Chainlink. There's news that's positive for Chainlink, but it also reveals something I found a bit concerning. Chainlink is launching a reserve of Link tokens. This means they'll be accumulating Link and won't touch the reserve for several years. The funds for this reserve will come from Chainlink users, banks, large institutions, and others who already pay to use the platform. The reserve will hold at least $1 million worth of Link. This is good news because it means a consistent accumulation of Link, which could create buying pressure. The way it works, they might collect fees in ETH, USDC, or other assets, then use them to buy Link for the reserve, or they might receive fee directly in Link and put those into the reserve. Either way, the reserve grows. But here's the part that caught my attention. I wondered how much Chainlink actually generates in fees across all its services. So I checked DeFi Llama, and the numbers are shockingly low. We've got roughly for the fees about $3 million annualized. That's really not much for a company valued at several $billion. And if we look at the actual revenue, it's barely $16,000. Now, the fees are basically all the fees that get paid, which can be potentially be passed on to other entities. For example, Chainlink might generate $3 million in fees, then pay almost all of it, close to the $3 million, to Oracle providers. These are the people responsible for fetching prices and putting them onto the blockchain. The net revenue is actually what goes into Chainlink's own bank or own organization. That I think is the most important thing to track. You want to keep an eye on both how much fees is being generated, and also how much of that actually becomes profit, because the fees will cap how much real profit the company can make in the end. Right now, the maximum they're making is $3 million in fees, but only $16,000 in actual revenue. That's not a lot for a company valued at $13 billion, for a crypto project valued at $13 billion. But then when you dig into the article where they share these numbers, there's something surprising. They actually say that Chainlink is already generating hundreds of millions of dollars in revenue. And honestly, I was shocked when I read that. Where is this money coming from? Why have we never heard about this anywhere? Well, they say most of it comes from off-chain contracts, meaning banks and institutions that pay Chainlink to use their service and platforms. Hundreds of millions of dollars is huge. That would put Chainlink among the top blockchain projects in terms of revenue generation. But here's the problem. There's no transparency about this at all. The part that worries me the most, and I might do a dedicated video on this like I did for Ondo to try and understand it better, is who is actually receiving this money. Is it really Chainlink's DAO, the decentralized autonomous organization, or is it a private company, Chainlink the corporation, which might have its founder as a shareholder and can decide whether or not to give any of that money to the DAO? That's a serious concern, and there's clearly a transparency issue here. If Chainlink is generating hundreds of millions of dollars, they need to explain where it comes from, how it's stored, and how it's distributed to its users. Could that reserve I talked about earlier be the first step towards sharing this revenue? It's possible, but right now there's still a lack of transparency. It's good they've made some progress, but we need some more details about the money flows and how it will be shared with Link token holders who are staking, for example. Because this is important. If you generate a lot of money, you need a way to give some of it back to your users. Otherwise, your token doesn't really serve much purpose. Look at Ondo, for example. Ondo generates a lot of revenue, but the Ondo token doesn't capture any of that value. It's just used to govern a small DeFi protocol, Flax Finance, which I already talked about. Now, to be clear, I think Chainlink has a real use case. I'm not putting it on the same level as Ondo, but in terms of revenue sharing, I want to see more details. I'll be doing more research over the coming weeks and I'll share with you when I have more information. Next, let's talk about stablecoins and stablecoin rating. Standard & Poor's, the giant US rating agency, the one behind the S&P 500 index, has just given a rating to the Sky protocol, which is the rebranded Maker DAO. They're the ones who originally created the DAI stablecoin, who is now called the USDS. S&P gave USDS a B rating. That's not terrible, but it's not great either. From what I can see, this is actually the first time they've rated the stablecoin. I'd love to see more stablecoin get rated: USDC, USDT, LUSD, and so on. The main criticism if they have is that USDS is still fairly centralized around its founder, Rune, who control nearly 10% of the voting rights. They've also mentioned the project is in the middle of a major governance transition, trying to reinvent itself. So S&P flagged that as a risk, but overall, B's rating is it's not good, but not bad also. It's good to see S&P entering the stablecoin space and providing analysis. This shows crypto is becoming more credible, and like I've been telling you, Wall Street is moving into crypto. That is a perfect example. If you want to position yourself around this trend, you need to think about where the largest stablecoins are currently deployed, mostly on Ethereum, but also on Tron. New blockchains are coming like Stable, and there's other blockchains specialized in USDT. We also have Solana. Personally, I would go for a tiny project trying to launch their own stablecoin. The competition is too fierce. Take Liquidity, for example. It's a great project. I really like Liquidity. I've invested in it, but it's risky to assume it will win the stablecoin war given how many players there are. You could also invest directly in Circle stock. That's the company behind USDC. Tether isn't publicly traded, but for me, I prefer investing in the infrastructure where stablecoins live, the foundation that will support not only stablecoins but many other use cases. And finally, let's talk about Pump.fun, the meme coin launchpad. They've announced something called the Glass Foundation, designed to help provide liquidity for meme coins in their ecosystem. In practice, they're going to inject millions of dollars into certain meme coins, big ones that might be lacking liquidity. So basically, Pump.fun is trying to pump some of its own meme coins. They haven't said exactly where the money is coming from, but remember, they've raised hundreds of millions and earned around $2 billion overall through fees and various sales. So they definitely have the funds to inject tens of millions into one meme coin to revive their platform and ecosystem, especially now that competitors like Bonk are taking more and more market share. All right, that's all for me. See you Monday for more. Bye-bye.